Welcome to Pipster. So if you're a trader, you know this feeling. From day one, there's this one huge nagging challenge. It's really just a two-part question that basically defines the entire game. Yep, these two questions, they're just always there, right? Every single time you pull up a chart, get it right, you make money. Get it wrong, well, let's just say we've all felt that pain. It's pretty much the source of all the stress and anxiety in trading. It's so true. I mean, trying to trade without a plan feels exactly like that. Sailing in a storm with no compass. You've got charts flashing green and red. News alerts are popping up. The market's just going nuts. It is so easy to get lost in all that noise and make a bad call based on pure emotion. So what if you could change that? What if you had a simple toolkit to cut through all that chaos? Well, that's exactly what we're going to do today. We're not looking for some magic crystal ball here. We're talking about building a practical, powerful toolkit. We're going to give you 3 essential tools for your trading workbench so you can move from guessing to making really solid, informed decisions. All right, let's open up this toolkit. Our very first tool is what I like to call the risk ruler, and it's all about managing the single most important part of trading, your risk. You probably know it as the average true range, or ATR. Okay, so here's the absolute key thing to get about ATR. It has no idea which way the price is going. It doesn't care if it's up, down, or sideways. All it does is measure volatility. It answers one question. How wild is the ride right now? Is the market just kind of chilling, or is it whipping all over the place? The ATR gives you a hard number for that, and believe me, that is a game changer. And why does that number matter so much? Get this. A recent VT market study found that traders who used ATR to manage their risk cut their drawdowns by, wait for it, 43%. That is huge. That's what happens when you stop guessing and start adapting your risk to what the market is actually doing. So here's how you actually use this risk ruler in a super practical way. Instead of just picking a random percentage for your stop loss, you use the market's own volatility. The 2x ATR rule is fantastic for this. It gives your trade just enough breathing room so you don't get kicked out of a good position by some random market noise. It's just smarter. Okay, tool number 1, the risk ruler, is in the bag. Now let's grab our next set of tools. These are our momentum meters. They're all about figuring out the power behind a price move. You can think of the RSI and MACD as the speedometer and the tachometer for your trading. Now, these two don't do the same job. They're like a team. The RSI is your scout. It's a leading indicator, which means it tries to give you a heads up that a change might be coming. That's why it's so great in markets that are just chopping sideways. The MACD, though, is your confirmation crew. It's a lagging indicator. It comes in and says, yep, a trend is definitely happening. It's your best buddy when the market is clearly moving in one direction. Let's look at the RSI. It's basically a scale from 0 to 100. When that line creeps up above 70, it's like the market is screaming, whoa, the buyers are getting a little too excited here. We call that overbought. And on the flip side, if it drops below 30, it's oversold. The sellers might be running out of steam and you could see a bounce. Think of these as warning zones. And here's the MACD's big move, the crossover. Think of it as a changing of the guard. When that fast line crosses up and over the slower line, that's your bullish signal. It's telling you that momentum is shifting to the buyers. And when it crosses down, well, that's the bearish signal. The sellers are taking over. It's such a clear visual way to see who's in control. Okay, so we've got our risk ruler and we've got our momentum meters. But here's the secret sauce. The real power, the thing that separates the pros from the amateurs, isn't using these tools by themselves. It's about using them together, and the word for that is confluence. Seriously, this one word could change your trading. Confluence just means you have multiple separate signals, all pointing to the same thing. You're not just looking for one reason to take a trade. You're building a case, you're stacking the evidence until the probability is stacked way in your favour. So what does that actually look like on a chart? Well, imagine you're creating a checklist. Okay, is the RSI below 30 screaming oversold? Yep, check. Are we seeing a bullish crossover on the MACD right now? Yes, check. And wait, is the price bouncing off a support level that has held up before? Check. See that? That is a high probability trade. Okay, having these tools is great, but just like any toolkit, you can definitely use them the wrong way. So let's quickly cover a few common mistakes that can actually make things worse, not better. Here are the big 4 pitfalls to watch out for. First, indicator overload. You know, when your chart has so many lines, it looks like modern art. Don't do that. Second, ignoring the context. Taking a little buy signal when the overall market is in a nosedive, bad idea. Third, forgetting about risk. Even the best setup can fail. And the last one, impatience. Jumping the gun on one signal instead of waiting for that beautiful confluence. This quote just nails it. If you add something to your chart and it just makes you more confused, get rid of it. The whole point of these tools is to bring clarity. They're your assistants, right? They're not a crystal ball. And that really brings us to the final, most important question you have to ask yourself. Are these indicators a tool for your decision making, or are they a replacement for it? Remember, a toolkit is only as good as the person using it. So use these tools to build your case, to manage your risk, to understand what the market is telling you. But at the end of the day, you are the one who has to make the call.